What's up, everyone? Welcome back to the channel, where we break down the biggest finance stories that actually impact your money. I'm your host, Ali, and today we're covering the most unprecedented Federal Reserve story in over a century. Before we dive in, if you want to stay ahead of the market-moving news like this, make sure you hit that subscribe button and ring the notification bell. Trust me, you don't want to miss updates that could protect your portfolio. So here's what happened. Late Monday night, President Trump announced he was firing Federal Reserve Governor Lisa Cook. This has never, ever happened before in the Fed's entire 111-year history. And the markets are already reacting in ways that could impact every single one of your investments. Let's start with the facts. Trump posted a letter on Truth Social stating he was removing Lisa Cook effective immediately due to alleged mortgage fraud issues. Cook, who was the first Black woman to serve on the Fed board, immediately pushed back, saying Trump lacks the authority to fire her and she will not resign. Here's why this is absolutely unprecedented. The Federal Reserve governors are supposed to be independent from political pressure. They serve 14-year terms specifically to insulate them from political interference. The law states a president can only remove a Fed governor for cause, meaning proven misconduct, not just policy disagreement. But here's the kicker. The market impact was immediate. The US dollar index fell 0.3% instantly. Long-term Treasury yields jumped while short-term yields dropped. Gold surged above 3,400 per ounce. European markets opened down significantly, with the German DAX falling 0.3%, and the Paris CAC dropped by about 1.4%. For beginner investors, this matters because when the Fed independence is questioned, it creates uncertainty about the monetary policy, and markets hate uncertainty. Now let's talk about what this means for your money. First, the yield curve is steepening. That's finance speak for long-term interest rates rising faster than short-term rates. This typically happens when investors worry that the future Fed policy might be too loose, potentially causing higher and higher inflation down the road. Second, the dollar weakness we're seeing could continue if markets believe Trump will successfully install more dovish Fed members who favor lower interest rates. A weaker dollar is generally good for commodities like gold and oil, which is exactly what we're seeing. Speaking of gold, it opened above $3,400 today, continuing its incredible run. JP Morgan is now forecasting gold hit at $3,675 by Q4 of this year, and potentially $4,000 by mid-2026. If you've been following my previous videos on precious metals, this validates the diversification strategy we've been discussing. But here's what's really important for your portfolio strategy. This creates a challenging environment where traditional correlations might break down. Typically, when stocks fall, bonds rise, but if Fed independence is truly compromised, both could fall together, as happened during high inflation periods. So what's next? Legally, this is going to be a massive fight. Lisa Cook says she won't resign, and constitutional scholars argue Trump doesn't have the authority to simply fire a Fed governor without proving actual misconduct in legal proceedings, i.e. court. But here's the investments angle. If Trump succeeds in removing Cook, it sets a precedent that could affect other Fed governors. This increases the probability of more dovish monetary policy, meaning more rate cuts, potentially faster than the market currently expects. The CME Fed Watch tool already shows 89% probability of a rate cut in September, up from 75% before this news. But now we might see multiple cuts this year instead of one or two that were previously expected. For intermediate investors, this creates both opportunity and risks. Low rates are generally good for growth stocks, REITs, and dividends-paying companies. But they're also potentially inflationary, which is bad for fixed income investments and could hurt the dollar further. My actionable insight is consider increasing your allocation to assets that benefit from dollar weakness and low rates. Things like international stocks, commodities, and inflation-protected securities. But also maintain some defensive positions in case this triggers broader market volatility. Here's your action plan based on today's developments. First, if you don't own any gold or precious metals, this might be the wake-up call you needed. I'm not saying go all in, but 5 to 10% portfolio allocation to gold has historically provided good portfolio insurance during periods of monetary policy uncertainty. Second, review your bond holdings if you have any. Long-term Treasury bonds could get hurt if this yield curve steepening continues. Consider short duration bonds or floating rate funds that adjust with interest rate changes. Third, international diversification becomes even more important. If dollar weakness continues, international stocks in emerging markets could outperform. The iShares MSCE EAFE ETF and Vanguard Emerging Markets ETF are two ways to get that exposure. Next, keep some cash ready. Market volatility often creates buying opportunities, and we might see some great companies go on sale if this uncertainty spreads to equity markets. Remember, we're still early in this story. The legal challenges alone could take months to resolve, creating ongoing uncertainty. That's today's breakdown of this unprecedented Fed story, but I want to hear from you. Are you adjusting your portfolio based on this news? Are you buying more gold, or do you think this is just political theater? Drop your thoughts in the comments below. And if this analysis helped you understand today's market chaos, smash that button that says thumbs up. It really helps the channel reach more investors who need this information. Don't forget to subscribe and hit the notification bell so you never miss breaking news that could impact your money. Remember, successful investing isn't about predicting every market move. It's about understanding the forces that drive markets and positioning yourself accordingly. Today's Fed's drama is a perfect example of why diversification and staying informed are so crucial. I'm going to be monitoring the story closely and will update you as developments unfold. Until next time, keep building your wealth, and I'll see you in the next video.